Dear students, please come to MCQ on Ind AS 109 and check how much you are prepared for these MCQs. First of all, 109 is a very important standard. All of you know that. And through these MCQs, we will have a quick revision of 109. Question number 1. Which of the following is not a category of financial asset as defined in Ind AS 109? Not a financial asset. Yes, please reply. Which is not a financial asset? FVT PL, FVT OCI, FV at amortized cost, loans and receivable. Please tick mark the right option. What do you think? Option A, B, C or D, which is not a category of financial asset? Please answer carefully. It is a financial asset. FVTPL is a category of financial asset. FVTOCI is a category. Debt instrument can be treated as FVTOCI. Okay, equity instrument can also be treated as FVTOCI. Debt instrument can be treated at amortized cost also. There is no category. There is no category called loans and receivable. It can be one of the three above, but it is not a category as such. The answer was D. Please tick mark option D. Question number 2. What is the principle for recognition of a financial asset or a financial liability in Ind AS 109? What is the principle for recognition of a financial asset or a financial liability in Ind AS 109? Keep a score also. Keep a score also. We'll see who has got the highest. And you will count only your first answer that you have given. Yes, please reply this answer. Read the question from the screen. Which one do you think is right? Anybody answer? You will mention question number also, because if reply comes a little late. Okay, many students have answered D. The answer is D, because a financial asset is recognized when and only when entity becomes party to the contractual provisions of the instrument. That is what is written in Ind AS 109. Very good answer. Tick mark. Give yourself 1 mark. Question number 3. In which of the following circumstances derecognition of financial asset is not appropriate? Derecognition of financial asset is not appropriate. Read the options and give me the answer. Read the options and give me the answer. The answer is C. You are right. The financial asset has been transferred and the entity has retained significant risk and reward of ownership. In this case, derecognition is not appropriate. In other 3 cases, the entity can derecognize the financial asset. You are right. Option C. Very good answer. That shows your understanding. Question 4. Which of the following transfers of financial asset qualifies for derecognition? Qualifies for derecognition. Think and answer. I am also thinking. most of the students have answered A. Answer A is right. If there is an option to buy back the asset at its current fair value, then you can derecognize. In other three cases, you will not derecognize. These are special cases where you will not derecognize. You are either taking all the risk and reward on yourself only, or the instrument are designed just for borrowing and lending arrangement, not for genuine sale. So answer A, tick mark. Question number 5. These are some very good questions I have found from reference books. Which of the following is not a relevant consideration? Not a relevant consideration when evaluating whether to derecognize a financial liability. Whether the option has been discharged, whether the obligation has been discharged, whether the obligation has been cancelled, whether the obligation has expired, whether substantially all the risk and reward of obligation have been transferred. Out of these 4 options, 3 factors are relevant for derecognition. One of them is not relevant. This is very easy question. Yes, come on. We are talking about financial liability, not financial asset. You can think again. In financial liability, we don't have to check this one. This is checked at the time of derecognition of financial asset. Okay. So the answer was D. The correct answer was D. This is for financial asset, not for financial liability. For financial liability, we have to check these 3 factors. Answer D. Question number 6 in front of you. Very important question. At what amount is a financial asset or financial liability measured on initial recognition? Very basic question. Financial asset or financial liability measured on initial recognition. And if you think two answers are possible, tick the best option. Tick the best option. Anybody answer, please? Answer, come on. Think and answer. There is no charge for thinking. Thinking is a very rare job nowadays. The answer is very simple, fair value. The very beginning of the chapter states that financial assets and financial liabilities are measured at fair value. Is it right? For items that are not measured at FVTPL, transaction costs are also included in the initial measurement. So the answer was C. This first one is consideration paid or received. Now this cannot be the correct answer because sometimes we give loan to employees at a concessional rate. We compute fair value. Parent gives loan to subsidiary at concessional interest rate, but we compute fair value. Again, acquisition cost cannot be the answer in all cases. Okay, because if acquisition cost is much below or much above the fair value, then we have to record at fair value, and the difference is adjusted in either P&L account or some other item. And then consideration paid or received for financial asset or financial liability. This A and D are exactly same statement to confuse you. If A is wrong, D is also wrong. Tick mark option C. Question number 7, please solve yourself. Under Ind AS 109, all of the following are the characteristic of derivative, except 3 options are defining derivative, 1 is not. Choose the odd man out. Anybody? Odd man out. Question number 7. Question 7. the correct answer is A, because the definition does not talk about the purpose of generating a profit from short term fluctuation. This is not the object or definition. Its value change in response to underlying. Yes, this is a correct part of the definition. It requires no investment or very low initial investment. This is also definition, and settled at a future date. So these three together, last three together, will be characteristic of derivative, but this is not. Derivative can be used for hedging also. So tick mark A. Question number 8. Under Ind AS 109, is a derivative, for example, an equity conversion option that is embedded in another contract, for example, a convertible bond, accounted for separately from that other contract? Is derivative contract separated from other contract? That is the question. Do we separate embedded derivative? Don't say yes, you have to tick the correct option. Yes, no, that I don't want. I want you to answer A, B, C, D. The answer is D. If you have read your standard carefully, the answer says it depends, and that there is a condition. The condition is that the embedded derivative will be accounted separately if and only if economic characteristic and risk of the embedded derivative and host contracts are not closely related, and the combined contract is not measured at fair value, with change in fair value recognized in profit and loss account. So this is what our standard talks about embedded derivative. Your answer D was right. Okay, question number 9. Which of the following is not a condition for hedge accounting? Not a condition for hedge accounting. They can ask question from any corner. Formal designation and documentation of hedging relationship and the entity's risk management objective and strategy for undertaking the hedge at the inception of hedging relationship. So this is a part of the condition. The hedge is expected to be highly effective in achieving offsetting changes in fair value of cash flow attributable to hedge risk. The effectiveness of the hedge can be measured reliably, and the hedge is assessed on an ongoing basis and determined actually to have been effective. This is also a condition. For cash flow hedges, a forecast transaction must be highly probable and must present an exposure to variation in cash flow that could ultimately affect profit or loss. Okay. The hedge is expected to reduce entity's net exposure to the hedge risk, and the hedge is determined actually to have reduced the net entity-wide exposure to hedge risk. This condition is not there. You can check. We have dictated or read these three conditions only. The answer is D, because the hedge is determined actually to have reduced. There is no actual proof required. It has to be highly effective. So tick mark D. That was a little difficult one. Question number 10. What is the accounting treatment of the hedging instrument and the hedged item under fair value hedge accounting? Under fair value hedge accounting, please reply. What is the accounting treatment of both the instrument, hedging instrument and hedged item, under fair value hedge accounting? some of you are answering A, D, so the correct answer is A. Correct answer is A, although D was also quite close. The hedge instrument is measured at fair value, no doubt. An hedged item is measured at fair value with respect to the hedge risk. Change in fair value are recognized in P&L account. Hedged item goes to P&L account. Hedge instrument goes to P&L account. When both are transferred to P&L account at the same time, the impact on profit and loss is very low or negligible or not there. This one, the hedging instrument is accounted for in accordance with the accounting requirement for the hedged item. This is wrong. The hedging instrument is accounted as per fair value only. That is, your point number 2 is wrong, because hedging instrument is always recorded under fair value hedge at fair value only. It is not measured at amortized cost. The question of a derivative measured at amortized cost is not possible. So option D is wrong. Any doubt? Any doubt? A was the best of the lot. Now next is last question. What is the accounting treatment of the hedging instrument and hedged item under cash flow hedge accounting? Very good question. Try yourself. Give me the answer. Yes, please read carefully. Read carefully, line by line, word by word. Anybody wants to reply? Look at this option. The hedging instrument is measured at fair value. With change in fair value recognized directly in equity, means cash flow hedge reserve, to the extent hedge is effective. To the extent hedge is effective, ineffective portion is transferred to P&L account. The accounting for the hedged item is not adjusted. Accounting for the hedged item is not adjusted. This is the right answer. Some of you said B also. So let me explain why B is not right. The hedged item and hedging instrument are both measured at fair value with respect to the hedge risk, and change in the fair value are recognized directly in equity. One student is saying change in hedged item we take at a fair value. Not necessary. It will depend on what is that hedged item. It will depend on what is that hedged item, and therefore hedged item is not necessarily measured at fair value. It will depend on what is that hedged item. Is it right? So the answer C is more appropriate. Answer C is more appropriate. Hedged item need not be always at fair value in cash flow hedge reserve. So that was the wonderful discussion on multiple choice question. I hope you enjoyed. Thank you very much. Please subscribe to YouTube channel AS Foundation, and we'll come out with more MCQs. Okay, also share with your friends. They will also be benefited. Thank you very much.